Joining us now is Vital Knowledge founder Adam Crisafulli and UBS Wealth Management Senior U.S. Equity Strategist Nadia Lovell. Nadia, welcome. First of all, at UBS, you guys seem to have a somewhat sunny perspective on where the economy is headed from here. You think yields are coming down, particularly on the 10-year, and the S&P can go higher.
Yes, I wouldn't characterize it as a sunny outlook. I would have characterized it more as a balanced outlook. We do expect the economy to slow, but we don't expect a recession. And so that should help bond yields to come down as well. And the fact is, we think that the Fed is done. We are also looking for a recovery in corporate earnings. We saw that starting to happen with the third quarter reporting season. We think that continues into 2024. We're looking for about 9% EPS growth for next year. And that should help to support the market to continue to move higher from here. And then with bond yields coming down and the Fed ending its hiking cycle and probably pivoting to cut sometime by the time we get to the middle of it next year, that should help alleviate some pressures off of equity markets valuation. And so we think that this market can go higher towards 4,700 for next year.
Okay, I don't want to miscategorize, but that sounds pretty sunny to me. I mean, if inflation actually comes down, yields go higher, stocks are better. Adam, what do you see as the key for the rest of this couple-week period heading into holiday sales? What's influencing where the market's heading?
So I think in the very near term, this is a seasonally bullish time of the year. You are getting a ton of evidence, both macro and micro, suggesting that yields should be lower. You're seeing growth cool, you're seeing inflation cool, you're seeing companies express caution on the outlook. It seems just within the last month or month and a half, there's been kind of a notable change to the downside as far as just economic momentum. That's something Walmart talked about. Other companies have echoed that as well. So you're definitely seeing, again, a lot of evidence supportive of lower yields. Stocks are going to welcome the drop in rates, but again, I think there's going to have to be a reckoning at some point with the implications of poor growth for earnings. And you're kind of seeing that play out a little bit today, this tug of war whereby rates are moving lower. That's helpful to certain parts of the market, but then the growth implications are offsetting that to an extent. So in the very near term, you have some tailwinds technically and seasonally, but I do think that's the market. You're going to see divergence where yields will continue going lower. But stocks are not going to rally commensurate, at least as they go through this process of kind of adjusting to the lower growth outlook.
Okay. Nadia, we had Cleveland Fed President Loretta Mester on our air earlier today. I want to play what she had to say. Take a listen.
My feeling is that it's really not about cutting rates, right? It's really now about how long do we stay in a restrictive stance, right? And perhaps have to go higher given what happens in the economy. So that's where my thought process is.
So this is interesting to me because as you just mentioned, Nadia, you think the Fed is done raising rates. There's a big difference between raising rates, especially as inflation continues to come down, assuming that continues to be the case, and beginning to cut rates. Big debate for 2024. Where do you fall in terms of the cut piece of this puzzle, and what does it mean for what stocks do next year?
Yeah, we're not as aggressive in terms of what the market is pricing in. The market has quickly pulled forward the rate cuts for next year. We think that the pivot towards cut in March seems a little bit premature to us. But that said, we think that the Fed is going to be patient on both sides of the equation and still wants to see some loosening in the labor market and also some loosening in terms of wage growth. And you're probably not going to get that until early next year. And so we think that the first cut is likely to come in the middle of the year to the back half of the year. And we're looking for 2 to 3 cuts for next year.